we know how to regulate banks. And, like the famous economist searching under the lamp for the keys, when in fact the keys have been dropped in the dark, but there's no light there. We know how to regulate banks, so we've regulated them. But we don't know how to regulate the shadow financial system, so we haven't regulated that as much. What happens if you put a lot of pressure on a balloon on one side, it balloons out on the other side? So is there a danger that by regulating the banks so strongly, we have shifted activity, not just risky activity, but human capital to the shadow banking system? That's a real question. And it's not necessary that, the old argument was, yes, we may have, but that's the unlevered part, so it's okay. It's not a bad thing. But remember, shifting activity may, in fact, if it's risky activity, that may be a good thing. But if you've shifted the smart people also out of the banks into the shadow financial system, I don't know if a less smart bank is less risky. Now, some people would argue that it was the smart guys who actually took the banks down, but the smart guys also do the risk management. The smart guys also do the project evaluation. Is a less smart banking system more of a risk or less of a risk? That's a question we should ask ourselves. Certainly, one of the ideas or the intent behind the regulation was to reduce the complexity and the financial engineering that was creating risks for the banking system. But in that process, have we also reduced the ability of banks to take needed real sector risks anymore? And that's again a question we have to ask. If, we're saying, where's the real investment? Where is economic growth? But even while we're asking that question, we have regulations which could, again, have the potential to pull banks from taking on real risk. For example, small and medium enterprise lending. From the perspective of an emerging market, we see it in cross-border lending into the emerging market or in foreign bank expansion. One of the things you see a definite slowdown is in the expansion of branches of foreign banks in India. That has slowed down tremendously since the crisis. And one could argue that this is a fallout of the global financial crisis and the regulation, because after all, at the end of it, we are a BAA country. And therefore, any entity within a BAA country comes up against the country ceiling. And so loans cross-border into our country tend to be seen as risky, require greater capital, and that could impair lending into the country. Those are three questions I've asked. Let me add a fourth. If, in fact, activity has moved to the shadow banking system, and there is a liquidity shortage like we had during the global financial crisis, do the right players have access to central bank windows anymore? Banks have access to central bank windows, but we moved the risk to the non-banks. If the non-banks have the risk, but they don't have access to the window, do we have the ability to cope with a financial crisis of the kind we saw in 2007, 2008? I think it's worth asking these questions. This lecture is a lot about questions, and I'm not going to say we know the answers, but I think it's really important that we start asking about the answers and see, because to my mind, if 7 or 8 years after the crisis, we still haven't got strong growth, a mantra which says, do what you did yesterday, looks a lot like what the generals did in World War I. You know the story, in the trenches facing each other. It was always send more troops over the top. And the troops got mowed down by the machine guns. And it was, we didn't send enough last time, let's send even more. And we have the same story again. We didn't do enough on policy, let's do more of the same kind of policy. Maybe it's time to start thinking, are there other reasons why we're growing so slowly, and what could they be? Let me come to my last issue here before I come to the emerging markets, which is, could monetary policy, easy and unconventional monetary policy, increasingly be part of the problem? I want to start by saying it was part of the solution post-financial crisis. Liquidity provision was extremely important. However, what was done then has continued, not just low for long, but increasingly inventive, innovative policies. And I think increasingly, and I've been preaching from the, been a little bit of a Cassandra about this for some time, but increasingly more people are coming to the view that negative interest rates, whole new talk about helicopter money, these are beyond the pale. That in fact, they may have perverse effects and not the effects that people postulate. But low for long, aggressive monetary policy for a long time, could it have essentially run out of steam? And I've already pointed to one effect of very low very low cost and easy capital, which is the inefficient firms don't get turfed out. But there are other effects. Remember, we talked about population aging. If you are in your 50s, you've just lost a ton of money in the global financial crisis, you're preparing for retirement, you like fixed income because you don't trust stocks anymore, and you want short maturity fixed income because you don't trust the long maturity anymore, because the central banks are all over that space. You have a target end of life savings, end of working life savings. You want double of what you have right now. What happens if the government reduces interest rates? Do you say, yippee, interest rates are really low, I can borrow and spend, and you go out into the market and buy anything that you like? Or do you say, well, the global financial crisis taught me a lesson. Things go up, things go down. Maybe I need to save more for my end of retirement goal, end of life retirement goal. And low interest rates mean I have to save even more, because income is really hard to come by. So what you have is a backward bending interest rate curve in the language of economists. The lower the interest rate, the more the saving rather than less the saving. People aren't going out and celebrating when interest rates get cut. They're actually saving more because they need their pensions. They worry about the viability of government-funded pensions and so on. There is a more sophisticated version of this, which some of you economics students here might recognize, called Ricardian equivalence, which is basically saying we all know the piper has to be paid at some point. And so if debt levels increase in a country, eventually instead of encouraging more spending, people start saving, knowing the tax burden to pay down that debt at some point has to fall on somebody. That's a slightly different version of what I'm saying, but they all amount to the same thing. You could have perverse effects of very low interest rates, perverse effects of substantial fiscal stimulus. These things eventually run out of steam. And of course, if you've moved asset prices to a place where people think it may be contrary to fundamentals, the fear of the volatility when those asset prices settle down again to fundamentals, again, impels more savings. Today, it's hard to think in the international economic setting of which assets you think are free of mispricing. I'm not saying they're mispriced. I'm saying there's a lot of uncertainty about mispricing given the extremely aggressive monetary policy. And that kind of environment where you're not confident of asset prices, the tendency would be to save more rather than to save less. Of course, the side of aggressive monetary policy that we see in an emerging market is that this also prompts capital flows. Now, many of your reporters talk about risk on, risk off. Now, risk on, risk off is not driven by the emerging markets for the most part. Yes, occasionally there's an emerging market event which prompts investors abroad to reconsider their options. But typically, risk on, risk off comes from the industrial countries, what is happening there. And in these risk-on moments, we get a flood of capital. We don't know what to do with it. It strengthens the exchange rate. The Brazilian finance minister, former finance minister Mantegna, complained about currency was as the Brazilian real appreciated tremendously and caused a significant current account deficit in Brazil, only to see the money flowing out and a huge depreciation since then in Brazil. So capital flows do tend to follow sentiment, not always fundamentals. And the flip side of capital coming in is it tends to leave at some point with significant currency depreciation and associated effects. Now, emerging markets don't like currency depreciation that much. But for industrial countries, it could be a boon. If I see my currency depreciate and inflation is relatively constant, I become more competitive and I can export more. Now, a third concern with aggressive monetary policy is that one of the primary channels through which it might work is by depreciating the exchange rate, right? Now, you may say, what's wrong with that? What's wrong with depreciating your exchange rate? Well, in an environment of weak global demand, when I depreciate my exchange rate, I'm making my goods more attractive to the other country's citizens. But those citizens in that country, they already have weak demand. And what we're doing is essentially taking their demand from them by depreciating our exchange rate. So if that country's authorities see this happening, what do? They say, well, we better depreciate our exchange rate. And what you have is competitive depreciation. This was actually a big concern during the Great Depression. These are called beggar thy neighbor strategies. You depreciate in order to take demand from the others. Now, no industrial country today, at least thus far, except for Switzerland, has directly targeted its exchange rate. Sweden is talking about doing it, but no country has done it. However, if in fact your interest rate sensitive segments, when you cut interest rates, they don't expand demand, your consumers aren't going out and buying, your firms aren't going out and investing, the primary effect of cutting your interest rate may be to depreciate your currency rather than to generate domestic demand. Now, monetary policy always got a free pass because you generated domestic demand, even though your exchange rate depreciated and you took demand from others, you also contributed to global demand because your domestic demand went up when you cut interest rates. If today domestic demand is not moving up, you're not generating any domestic demand, but you're shifting demand from other countries, your policy, monetary policy, may also be suspect. It may be a policy which essentially should be proscribed by the international community because it's demand shifting rather than demand creating. Now, I think these are possibilities. The question is there a reason why this might become more acute in these times? And I want to end this discussion about monetary policy by saying yes. And that's because we have a number of inflation targeting countries across the world or regimes across the world. One of the issues with inflation targeting is you have a problem with if inflation exceeds the upper bound. That's the problem that we have been more focused on in India because we have high inflation. But you also have a problem if inflation falls below the lower bound. This is the problem in industrial countries. Now, when inflation threatens to fall below the lower bound, central banks could throw up their hands and say, look, we really can't do very much more. We've done everything we can. Interest rates are at zero. We can do nothing more. However, in recent times, we have one magic solution if interest rates fall below the lower bound. And that's called the helicopter drop of money. Now, for those of you who don't know what a helicopter drop is, take money, print it by the central bank, put it in a helicopter, take it up, throw the money out of the helicopter, falls all around, people find money, go out and spend because it's their lucky day. And you get growth, you get spending, you get inflation pushed up, and everybody's happy. right? At least that's the theory. And so with the helicopter drop as the nuclear option, the argument is no central bank can remain satisfied when inflation is below the lower bound because there's always that nuclear option. So you must continue more and more aggressive policies until inflation comes back on track. This is the mantra in a number of industrial countries. Now, it's not clear that if you drop money from a helicopter, people who get that money will go out and spend it. They might think the government's gone crazy. Let's put the money in our pocket because things are going to get from bad to worse now. Or what does the government know that we don't know, that they're throwing money out of the helicopter? This must be really, Kali Yuga, and let's adjust.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.